Good morning, everybody, and thanks for joining us today. You obviously all know who I am, and I'm pretty sure you know who these two are. I guess today, Caroline and Matt, your portfolio managers, so we hope you know they are. Topic today is part of our WTF series, and it's just a follow-on from earlier this year. And what WTF is still going on in your portfolio. As I said, it's a continuation of the webinar we did earlier this year. Markets are still all over the show. There's just as much noise. There's some new spinners in the works. Eskom, we'll deal with that later, maybe touch on that. I just thought it'd be a nice way to end the year, kind of just recapping what's happened this year and what we anticipate to happen going into next year and what we think is going to play out. And by we, I don't mean me at all. I mean Matt, Caroline, and the investment team at AdviceWorks, right? So investment management's not my game, and I really rely on Matt, Caroline, and the other PMs to kind of help us out here. And importantly, they don't work in isolation either. So there's a team behind them, and that team has been doing a lot of work. And we're going to touch on that today as well. You can't always see the work that's going on because 90% of the time, if you're not having a chat with us, it's the only evidence you see is when trades are made. But just because trades aren't being made doesn't mean decisions aren't being taken in the back end, and I think we'll touch on that. It's just important to know that although you can't actually see anything happening, there is a lot going on. So yeah, with that said, guys, I think let's maybe jump in. Start with a recap as to what's happened over the last 12 months, locally and abroad. Who wants to go first?
Maybe I'll kick it off. Morning, everyone, and Caroline, just jump in as you feel necessary. Marc, I think when last we met, we were probably in almost the eye of, or what seemed then was the eye of the storm. I mean, the markets were down 20-odd%, and it really seemed in the eye of the storm. And all this, when we met sort of middle of the year, this has all been triggered by events that happened at the beginning of this year, and we saw rising inflation in January coming into the market, and then obviously the war in the Ukraine in February, exacerbated that rising inflation. So we are sitting in my view, the biggest sort of problem that we are facing at the moment globally is rising inflation and how we get that under control, or how do central banks get that under control. And central banks have effectively one lever to pull, and that's increasing interest rates to bring inflation under control. And this event has really caused the big upset in global markets, as we are seeing now, and we are going through. And it's a change, as Caroline alluded to in the last meeting. The developed market doesn't know really what inflation is. They're not used to inflation. South Africans, we're quite used to inflation. It's been around for a long time. We're used to inflation 5-6%. But when you're getting inflation in 8% in the US, what does that actually mean? So they have to increase interest rates. So you've seen interest rates go up, at one of the highest and quickest levels in many, many decades. The US interest rates have increased, and that naturally puts pressure on stock markets and shares. And that's because of two sort of factors. You're discounting future earnings at a higher interest rate. You've also got another alternative. We haven't had alternatives in the past. So in the past, if you were an offshore investor, you didn't want to invest in cash because you were earning no return on it, or 0%. So you had to go into equity. So that propped up equity. So there's been this change globally that's happened this year of higher interest rates. And I don't know if Caroline might want to touch on some of the drivers behind those higher interest rates. I'll let her touch on that if she wants to jump in.
No, look, it is inflation. We had the first inflationary shock in January. That was the first time your portfolios went down. And I think all else being equal, I think I mentioned this, is that, we would probably have been through the shock at this point. We would probably have expected to see portfolios up but very slightly. Unfortunately, we did have a mad dictator, throwing a spanner into the works. And, while market tends to struggle for war, this, because of the country, that he invaded, it's hugely inflationary. It's inflationary from an energy price perspective. It's inflationary from a food price perspective. I think one of my favorite one of the most interesting company results I've seen this year has been for Astral Foods, so our chicken producers. And it's worth a look because, they touch on a few things that are problematic from a South African point of view, but also from an international point of view. They're definitely seeing an increase in food, grain that they feed their chickens. They're seeing an increase in, the cost of petrol, when they ride around. And of course, the fact that you've actually got to, and Mark, you did say you're going to touch on this, but this is how it goes to the bottom line of business. They actually had to really set up their own infrastructure, water production, water supply, electricity supply, because you can't just switch these things off, to chicken batteries. And what they have said, and this is worthwhile, because thinking about for next year, is that up until this point, they're actually subsidizing the cost of what is one of South Africa's, biggest proteins, especially for the lower middle class and the lower class. So what we're going to see is, through next year, it's that inflationary impact is still going to be rolling, sure, and we're going to see increased food, increased prices across the board. We haven't seen the end of this. I do think we can have a very difficult first quarter.
So, Caroline, just maybe to stop you there. So you're saying Astral Foods are saying that they've seen a rise in their, not only in the import costs, right? So grain and those things, but also in their production costs. So electricity, water, and they've had to take on their own production of those things, right? So through solar and water harvesting and whatever it is. And up until this point, they've absorbed that cost, right? Because setting up these things is obviously very expensive. So what you're saying is into next year, they will obviously no longer carry on absorbing it and pass that on to the consumer. So from a South African context, we anticipate inflation to kind of keep rising or keep at the levels that it's at, not sort of taper down again.
Look, I think from a South African perspective, I don't think, just remember, if you're going from, 2% inflation to 3% inflation, that's a massive jump. In South Africa, if you're going, it's in increments, it's a lot less. So we don't immediately feel it as severely as offshore does. There's not a shock. But, just to see how much those input costs actually come into our market, I think especially in as regards food supply goes, it's going to be interesting to see. And then I think quite likely we're going to be seeing increases in what we pay for electricity. Well, we pay for no electricity. All of these things, it's going to come through during 2023. We've been very fortunate in South Africa this year in that we have our market has not been as badly affected as offshore. And, I think we weren't as our valuations weren't as high as the rest of the market going into the end of 2020, 2021, or is it 2020? 2021.
2021,
It's that time of year when I need to make an adjustment. So that was part of it, but also, we were shielded. Our banks are good, our retailers were good. We were helped in the second half by the weaker rand. And, we've been given a gift, as far as commodity prices go. I just feel like, in a way, we're shooting ourselves in the foot now. Eskom is not helping.
Let's maybe just stop there, right? So in a South African context, our inflation has also been pretty high, right? It's been above the 6% band that the Reserve Bank like to keep it in. And I think it was like 7.4% it came in yesterday or something like that, right? So that's still relatively high, but our market in South Africa is positive, right? Positive year to date. So why is that, right? Why is the local market going to say weather inflation or been able to perform?
Look, Yeah, I don't know, Matt, if you want to take this, but we've got a very skewed market. There's a lot of very big multinationals who are around hedges, that flatter the market. And of course, we've got Sasol, which was, energy was our best performer. So if you look at the sectors, energy is way in the green, and pretty much everything else is sitting in the red.
Yeah, if you look at sort of our market and just how the JSE is structured, as Caroline says, we've got these big multinationals in it. We do have the likes of a Richemont on luxury goods. You've got your Sasol on the energy side of things, and your resource companies as well. And the resources, as Caroline, we got a bit of almost a gift, because we are a very similar. Our commodity basket as South Africa is quite similar to Russia in terms of platinum and palladium. So those sort of export commodities that did nicely when the sanctions were imposed on Russia. Well, we were one of the few countries that actually also mines them. So they sort of got a boost from that. So the resource companies did nicely. And as Caroline also said, our valuations were a lot lower than the rest of the world. So the JSE is actually quite similar to the London Stock Exchange in terms of its composition. It's got quite a lot of resource heavy shares, not a lot of tech shares. And where we saw a lot of pain was in the tech shares, and that's because their valuations were quite high. They were priced at high PE multiples. And what we saw this year was not necessarily that the market pullback came on PE devaluation or PE re-rating. So these PE multiples, the value of the company came off. Not necessarily that we saw the earnings getting hurt too much. I mean, overall, the market's earnings are slightly grown this year, but it's really been down to a valuation because the market's looking forward, and the market's looking forward into next year, and the market's looking forward and saying, well, at higher interest rate, what does that do? And these higher interest rates hurt these growth kind of businesses, these tech businesses. So if you look at the US and the stock exchanges in the US, which are quite tech heavy, those have got hurt hard. But the other exchanges around the world, like South Africa and the London Stock Exchange, we were kind of protected a little bit from that. And that's why we're seeing the JSE at the moment slightly positive. We were a little bit protected from this whole thing.
Okay, so JSE protected, positive for this year, right?
Relatively protected. I mean, relatively protected.
Look, positive is positive, right? It's not a negative number. It's very low single digits, but you sound pretty apprehensive about going into next year, right? So, are you alluding to some pain in South Africa potentially because we may not be as protected as we were this year?
So I think from an economic point of view, the globe was probably going to feel quite a bit of pain next year as inflation bites, as Caroline alluded to, in South Africa, and as higher interest rates start to take effect. And then we are probably going to sort of see some mild recessions, I would expect, next year coming through. But that doesn't necessarily mean equity markets will do poorly, because equity markets look forward. So, the equity markets aren't pricing in what's happening now. They're trying to see what's happening next year and 2 years out. So they kind of look forward. So I think a lot of the pain that we've experienced at the moment is probably pricing in a tough start to next year. And we might again test some lows that we had, when we last met in June, July, those sort of lows in the market, in sort of the third quarter of this year. We might still test those again next year because we've had a little bit of a recovery now. And then, as we sort of go through, I would expect that the US might go through a bit of a shallow recession, Europe as well. South Africa, probably can touch on it a bit later, but given sort of the energy crisis we're going through at the moment, I think it's going to be a lot harder for us to sort of to grow GDP quite nicely going forward. I think it's going to be a struggle for South Africa at the moment. So along with the rest of the world, we're probably going to struggle economically, but that doesn't necessarily mean stock markets will struggle next year because they're going to look forward into 2024 kind of thing. And we've already had the valuations come off. So I would suspect that quite a lot of this bad news is almost priced in for next year into a lot of these businesses.
Just, you kind of alluded to the fact that things were pretty bad when we last met, right? But it does seem like they've improved slightly, right? Well, markets anyway. So let's not the world, markets, right? Inflation is still there. It hasn't come down, substantially. Interest rates are still high, but equity returns have sort of improved in the second half of this year.
Yeah, so I think maybe it was a misunderstanding on the part of a lot of investors. I'm going to be the outlier here. So, we obviously saw interest rate increases throughout the year, and every single month when there was this interest rate increase, and this is I'm talking about the US Fed. You saw quite a big downward correction in the market because it was 75 basis points every single time. And you alluded to inflation, and inflation is still growing. It's just growing at a slower. It's still increasing. It's just increasing at a slower rate.
Yeah.
And I think we need to bear that in mind. And I think a lot of market participants kind of don't really fully grasp that. It sounds very odd, but they don't. And when the Fed come out and say, listen, we're going to have a higher terminal rate of interest rate increases, and we're going to be increasing interest rates for longer, it doesn't matter that we're not going to be increasing it at 75 basis points every 2 months. It's now going to be 50 basis points. The market just kind of ignored that in the last 3 months of the year, and I think that people are just they're looking for some form of positivity and really not looking at the fundamentals of what is going on there. That said, I'm not terribly negative. I do think, like Mathew said, a lot of it is in the prices already. Again, like Mathew said, earnings offshore are still increasing, especially in those tech companies. They're just increasing at a slower rate. And it's worthwhile remembering that when you look at your portfolio, that the share price is down. It doesn't usually, your share prices very rarely mirror the company conditions and the market conditions. It just very often mirrors sentiment in the market. And it's worthwhile that whatever you're holding in your portfolio, it is a company whose earnings are stable and probably increasing as well. They're probably increasing by 10, 15, 20% instead of 30, 40%. So it's worthwhile putting that into perspective.
So earnings are still increasing, which means the companies are still generating profits. It's just not at the rates that they previously were, right? And the value of the shares is down. It's less. It's declined because of market sentiment, right? So, okay.
Yeah, I think if I can use an example, Mark, if you look at Amazon, Matt, what is it down this year to date? I think it's about 35, 40%. It's massive. Now Amazon's not going to go away, and it's just the wrong environment for Amazon. Well, first of all, it's very highly valued. So as Matt explained, the discount rate we use does actually take a lot of the valuation. But also, it's consumer facing. And and I don't think consumers have even been under pressure yet, like I explained, here and offshore. When they do start to see that pressure, a consumer-facing company, is going to get hurt. So the market has really, really hammered it. And, if you look at it logically, Amazon is not going away. It's going to get bigger. We're not going to be in a recessionary environment forever. People will adjust to higher inflation rates. And, especially if you look at the US unemployment rate, the employment rate is still very, very high. So, we do need to look through, and I know it's been a tough year for people. We've said just, look through it. But, you're going to have to look through beyond 2023 and look at this is still, these companies that you've got in your portfolio are still very strong companies, very good business cases. And, there's no point in turning away from them because you're in the cycle you're in.
So let's just maybe look at Amazon, Caroline. That's a good example, right? So you're saying that it's down, what, Matt, like 30, 35% on the share price, right? So it's down. So people would see that reflected in their portfolio, and they may be like, why are we still holding on to Amazon, right? We've lost so much money, right? We've lost so much money. But what you're saying is they're still generating profits, right? Just not to the extent that they were. So why has the share price fallen so hard then, right? Number one. And number two, you mentioned, that the consumer hasn't really felt the impact of inflation. And if they're consumer focused, then there's potentially still some pain to come their way, right? When the consumer does feel that. So those things counting almost against you, what gives you guys comfort that we would still ride this out and that they will come out on top at the end?
Well, it's the largest e-commerce platform in the world. Let's put it this way. And it's an e-com. It's not only an e-commerce platform. It's got a lot of other strings to its bows. It's got a growing entertainment focus. So the competition with Netflix and Disney is there. It's also got a cloud software business. So there's a lot of things that can contribute to it. And I'm not saying it's my favorite stock out there, but it is a great example. It is a great example of
diversified earnings, right? And I think we're pretty blasé about the fact that e-commerce is not going away. But when we say e-commerce, you refer to online shopping, right?
Yes, correct.
Which is
Yes, online shopping. So the types of things I like to do. For me, that's just e-commerce shopping. So it encompasses a lot of other things. Yeah, so and Amazon has also got a growing business model. It's bringing more third-party vendors onto its site. The penetration, when you look at these e-commerce companies, you think it's ubiquitous, but it's not. There's still a lot of places that can actually grow into. South Africa is a great example. When they finally get their head office built.
If they get it done,
going to be growing there. I don't know with our rand if they can make a dollar profit, but what tends to happen, we saw it in 2008 and 2009 as well. If you look at the share prices of all of these, high growth companies, absolutely got hammered. I think they were even down worse. They were down 40-50%. Some of them even more. And when you come out of a cycle, a recessionary cycle like that, what I always say is those big companies that are cash generative, well managed, don't have a lot of debt, actually come out way better than anybody else. And the reason is because their competitors fall by the wayside. It's actually a fantastic opportunity for them if you're still generating cash. And I think that's the important thing when we evaluate these shares is, we don't trade for a 6-month period or a 1-year period where we're looking forward. But I think that, just what you mentioned, at the beginning, when we started, you said there is work being done in the background. And what is being done in the background is a very stringent analysis of cash flow, debt, especially in a rising interest rate environment, and just business ability. Is this business still going to be? Is it still going to be a business that is viable in 3 to 5 years' time?
I guess what you're saying is, you look at Amazon and saying, is the business model going anywhere? Is it changing? Are people going to stop shopping online? I think the answer to that is no. The penetration into different markets is probably just going to get higher. Do they have a lot of debt? And I think you're saying no, because debt would be a problem because the cost of debt is rising. So therefore their repayments are increasing, right? And then are they still generating cash? So are they still making money? And I think if the answer to those are positive, then you're happy to continue to hold the stock, because like you say, the smaller guys will fall away if they don't get absorbed by Amazon in this example. And when sort of the market turns and people start spending a lot more, they're going to be on the receiving end of that. Yeah,
absolutely. I don't know if Matt disagrees.
No, I agree completely there with sort of how you summed that up, Mark. I think that was perfect.
So I'm gonna ask you a question that every client wants to know. So if we know this, guys, why don't we sell it and then when it turns around, buy it again? Is that not your job, guys?
We're not psychics, unfortunately.
Yeah, trying to time those sort of moves is near on impossible. When to sell it and when to buy it back. And it is a question we get asked a lot, and it's not a bad question, it's a very good question. And I always sort of say, let's go back and look at the COVID crisis. And it was a bear market. Markets fell sort of 20% in that crisis. If you had sold out there, you missed the rebound that happened in 2 or 3 months, the markets rebound. So when you go back in, you have to be, your selling decision, I often say, could be right, because that's often a fairly easier question. The tough decision is when you go back in the markets, because then you sell, markets are down 20%, you're nervous, you don't want to go back in. Are they going to fall another 10%? And when markets run, and they run hard and they run quickly, 2 days, you could see 10% return kind of in the market, a 5% return one day and next week's another 5% and you've missed out. So that timing of the market is extremely difficult. Ultimately, we're long-term investors. We don't try and time the market. We'll take a long-term view and we buy these quality businesses because of that, because timing of the market is near on impossible.
I think something for me that, sorry, Caroline, before you go, it's that I've always gone back to is this offering that we have. It's private client asset management, right? As opposed to share trading, right? Where you guys are managing the assets with a long-term view to deliver a specific targeted return, which is what we come to you with. We say our client's planning says we need inflation plus 5 to 7 or whatever it is. And then you put together a portfolio of stocks that can deliver that over time, right? As opposed to, things that people may see on TV and think that's what owning a share portfolio is, like billions and trading and buying and selling and high and low and all of that stuff. That's trading as opposed to actively managing their wealth to generate a long-term return.
Yeah, you're quite correct. The trading, trading for high net worth private clients really became very unattractive when capital gains tax was introduced. Okay, so you take a large percentage of your profit from capital gains tax, also from trading costs, and like Mathew said, that lost time opportunity. So, and I think it's very difficult for clients who, to understand. We've been in the market for a very long period of time. I've been in the market for decades. Literally way longer than Matt and Marc combined. But when you look at and consistently over these periods, is that the buy and hold strategy does work. It really does. If anybody is concerned about there's so much research, there's so much historical research that actually shows that do the homework up front, hold, sit through cycles, and you're going to end up positive. As time goes on, your downside is going to be limited. And it's really worthwhile, remembering that, if you want to take your own time and go do the analysis of the S&P 500 or the JSE, you're actually going to see that is correct. The worst thing that you can possibly do ever is to have a knee-jerk reaction, because that's just an immediate erosion of wealth.
I'm going to sort of quote something Warren Buffett said, and I'll probably get the quote wrong, so I just apologize up front. He sort of says he's happy to buy companies that that if you can't trade them in the next 10 years, you'll buy them today, and let's say the market closes for 10 years. In 10 years' time, you'll open up the market and still be happy with those businesses, because those businesses will withstand all economic sort of cycles, the good times and the bad times. And it's a fairly sort of similar thing that we try and do at AdviceWorks as well, is we want to buy companies that we are happy with to hold for the long term.
So Matt, look, so that sounds great, right? But maybe you can explain what actually happens in this 10-year example, right? So, because clients aren't paying you to buy a stock and look at it again in 10 years' time. And I'm certain that's not what happens. So maybe you can just give some insights into what does happen. And maybe you could give us some examples of what you guys have kicked the tires on, as you all love to say, this year, right?
Yeah, so that's a good. So we look at the shares, all the time.
What do you mean all the time? Right, you're not sitting there every day looking at the shares, right?
No.
So are these like structured meetings that are in place, get-togethers? Yeah. What does it look like?
There's structured weekly meetings that we attend, put input into all the various portfolios, and there's various committees. We maybe just to take everybody a step back, and I'll just mention sort of the team, that we have behind us, because that's probably quite important and often gets overlooked. So within the team, within AdviceWorks, I think we sort of sit on about 6 portfolio managers, and then we have the Old Mutual team, and the Old Mutual team's probably got, a portfolio management team, which is quite substantial, and then they have a research capability team, and then they've got about 3 or 4, maybe more, 4 researchers that continually kick the tires in various companies. We also then get external research, from the likes of Standard Bank and JP Morgan, who provide us research into the sort of this melting pot. So you got portfolio managers, you have a research team, and you get external research. And between those sort of components or those cogs, we come up with the best investment sort of view. So you would have, so how it sort of works, the external researchers, JP Morgan, Standard Bank, you need them because you want to get different opinions. Our research team may come up with opinion A on a share, and you want to sort of test that against other people in the market. So we buy in research from them as well. And then it gets tested amongst the PMs as well, who also have their say in the matter, and then the shares get put into the portfolio like that. So you sort of say, well, how does this whole team work and function, and what are the decisions you kind of make? Well, for example, earlier this year, we added Apple into some of the portfolios, and that was because we were aware of higher interest rates, how that impacts companies. And Apple sits on a fairly hefty cash balance, so they're not exposed too much to higher interest rates, and that we think they can withstand this sort of cycle. So that was one of the shares that we added into our portfolios earlier on in the year. And we constantly
also, does it have anything to do with Apple being sold off? So what is this, a good time to go and buy Apple? Or is it just we looked at the stock and said they'll be able to perform better in these conditions?
Yeah, so there was also a valuation element to it, which means it had sold off a little bit. So it was sort of an opportune time to add it into the portfolio. So we did that sort of trade as well. So these are the things that we are looking at, constantly. When I sort of mentioned that 10-year kind of view, what that stops us from doing is when we want to have this long-term view on a share, it stops us buying a share that we are going to say, well, we like it for a 6-month view and we're going to sell it out in 6 months. It's probably unlikely, there will be shares in the portfolio that will form the backbone of the portfolio that will stay there, for 10 years. That are these businesses that are going to be good, solid companies, a Nestle, for example. I mean, it's probably never going to really shoot the lights out. It's going to tick along nicely for almost into indefinitely. But there are other shares that that may, we'll hold them for 5 or 6 years and probably exit them. And if there's a problem, we'll sell it earlier. So if we notify that share, has got a bit of a problem, we'll get out of it. We're not going to hold on to a share for 10 years in all instances of the portfolio. So there are shares that we look at, we say, well, that's got a problem, let's exit that share, because our original investment thesis when we bought that share was for a 10-year view, but things have changed in that business now, and our view on it has changed. And if it's changed to the negative, then we'll exit that business.
Yeah. Just on Apple as well, on the portfolio system, we bought Apple, but we sold something else. And sorry, my brain is not functioning. It is near the end of the year. I can't remember. Starbucks, that was what it was. So we made that switch, because we looked at the business model, said the Starbucks, we don't want to be in it, and we went into Apple. So
that was going to be my next question. Is
carry on.
You held Starbucks, right? And you kind of, so what was it about Starbucks that when you looked forward, you said, actually, this is not something we believe we should hold in our portfolio for the next 10 years in this sort of story?
Yeah, so can I jump in there, Caroline? Or?
No, go for it.
Okay, so with Starbucks, when we made that decision, we had higher inflation. Now, when we looked at the US, we had this higher inflation, and higher inflation will come and go. But, that was kind of impacting Starbucks. Starbucks has a bit of debt on there within them, so that's a negative for higher inflation. Coffee prices had increased, and Starbucks as a business, its margins are tiny because it sells coffee. You don't make high margins on your coffee. It's kind of small. And there's wage inflation. Now, the US has been sitting with, basically almost full employment. There are more jobs out on offer than people who are looking for jobs in the US. So Starbucks being quite a big employer in the US, to attract new talent or people to come be a barista or serve your coffee, they've got to pay them more. That eats away at their margins. And now if you sort of look that forward, I think could be quite sticky in the US, this high employment rate that they've got. And that's impacting Starbucks. Then if you look at Starbucks gets quite a big portion of their revenue from China. And we've seen these Chinese COVID lockdowns that have been extremely harsh. And, you know, as the rest of the world has opened up and China's remained sort of with hard lockdowns, that impacts, you know, Starbucks as well, as they can't sort of sell coffees. So when we put all these together, you know, our sort of longer term view on Starbucks became quite negative. And we decided, right, we'll exit Starbucks and sort of replace that with Apple, because we view Apple over a longer term now as a bit more of a resilient business than Starbucks going forward.
Okay, so yeah, look, I guess that makes a lot of sense. They've got debt. It's going to be more expensive. Their input costs to making coffee are rising, and the margins are very low as it is, right? So it means less profits into the future, which are two of the things that you guys said earlier, or what you look for in a stock that you're happy to hold.
Correct.
So it doesn't mean it's a bad business. It just means that it's almost like its growth, its road of growth has almost come to a halt. There are better opportunities there.
I think, well, that's it there, right? So you, part of your mandate is to deliver a return. Starbucks is not a bad company. It just means it's not going to aid you guys in delivering that return to clients. And you feel that Apple...
Correct. Over a long, I mean, just walk around, you know, South African malls. You know, there are Starbucks where there are going to be Starbucks. There's not going to be more Starbucks.
Yeah.
You know, that's the growth is pretty much at the end of the road, in our opinion. Maybe, you know, we may be wrong, you know, but when you look at things logically, like that, with the information we have at hand, you know, it really does appear to be the case.
Okay. So in the global portfolio, maybe we can just touch on what has performed and what hasn't, and if you see that changing at all going into 2023. So maybe what has performed?
Oh, Matt.
Yeah, so I mean, obviously when markets are negative as much as they are, there's a lot of things that have underperformed. But if you look, you know, some of the performing shares, you've got the likes of Berkshire Hathaway, Johnson & Johnson, you know, that have held up quite nicely. And Dana has another one, you know, on the medical device side of things, you know. So these sort of shares have done quite nicely relative to the rest of the market. So if you sort of look at Danaher medical devices and those sort of things, you know, intuitively you kind of always need those sort of products. Johnson & Johnson's another one that's held up fairly well. So these are kind of the shares that have done okay over this sort of period. But when markets do sell off like this, there's often very little place to hide, you know, unless, you know, particularly in an offshore portfolio where, you know, we don't invest in energy companies or oil companies because, you know, when oil price goes to $100 a barrel, they make plenty of money and it's all good. And then, you know, next year oil goes down to $50 a barrel and these companies are struggling a little bit. So they're too cyclical for us. So that's probably one of the areas that or energy has performed very nicely this year. We're not in energy because it doesn't really match our investment style. It's too cyclical. You know, 1 year energy does well, the next year it doesn't do well. We like to buy for the sort of the long term.
Okay. Kind of a vague answer there, guys.
Yeah, I'll give, you know, on what has performed well. So I mean, you know, like Matt, everything, you know, there's very little place to hide. And part of that reason, you know, you've got to remember is, you know, offshore investors are not only buying individual stocks, they're buying exchange traded funds, you know, and these funds are massive. You know, and these exchange traded funds by and large are held by retail investors as opposed to institutions. So when and you've got to think the tech sector in the S&P 500, you know, it's between 25 and 30%, depending on where prices are at any point. So if the tech sector sells off and people start to sell off, you know, the exchange traded funds, everything goes down. It doesn't matter if there's the best quality company that you could possibly have, the price is going to go down with the amount that, you know, that has actually been sold off generally. So companies get punished initially, and we did see that. But what we saw after the first few months, you started to see some of those, you know, those dividend achievers, those more conservative companies, the prices started to actually, come back to almost normal. Pepsi's a great example. Coca-Cola is a great example. And they're probably the right companies to be in at this point in time. It's, and again, when we make portfolio adjustments now, we're also looking at this point and saying, look, we're going to have lower growth for longer. So we'd like to have dividends. So that's another active decision that is being made, is that, yes, we're in this cycle where we are now. So when we've got cash, that's where we look.
Yeah, so if we're looking forward to 2023 on a global perspective, what do you guys think we're in for, right? Leading into the year, and how does it play out throughout the year?
Yeah, so there are actually some positives. I mean, if we look now, when we were 6 months ago, we sort of, we were very worried of where this interest rate cycle is going to go. I think we're becoming a little bit more clearer than that. The US rates are going to be somewhere around 5%, where they'll stop, and they'll probably stay there for kind of the year. And as we go into the first quarter next year, we'll even get a much stronger idea of where inflation is going to go and where interest rates are going to go. We're starting to see some early signs of inflation starting to come off. I mean, we'll only know in hindsight if it is actually coming off, but there is some early signs of that. The big concern is that central banks do too much. They tighten too much. They increase interest rates too much, and that puts a cap on growth. And I think already in going into next year, we are going to see, slowing economies as these high interest rates start to bite, as people have worked through their savings. When people saved during COVID times, they're starting to go through those savings. So I think economically it's going to start to bite next year. But from a future outlook, we'd probably be a bit more assured of what's going to happen into 2024. I think you've also got China starting to reopen. So then that's quite a big move. I mean, with the Chinese and the hard lockdowns, which has really disrupted supply chains across the world. You have, for example, an Apple iPhone factory that shuts down because it's in the middle of one of their hard lockdowns. I mean, that by itself is inflationary as you start to disrupt supply chains. We are starting to see the Chinese starting to relax some of those measures now, which hopefully they continue to do into next year, into the early parts of next year. So that's another positive. I think what's going to happen economically next year, there'll probably be some shallow recessions as these interest rates start to bite. Markets will be volatile on the back of that because they don't like uncertainty and don't like when you're going to see into a recession. But I think what will probably start to happen first quarter, second quarter next year, as the market starts to look forward into 2024, and then things should start to recover. And the market recovers before the economy recovers. The economy recovers, and the market also, as what we experienced this year, has pulled off on the back of what it thinks is going to happen in the economic environment in 2023. So I'm probably, it's going to be a bit of a rough ride from an equity perspective next year. But from an outlook perspective, we're probably going to be a bit more clear on what's going to happen going forward, because, we are seeing very early signs that inflation is starting to turn. And if we become a little bit more positive on what we think is going to happen in 2024, the markets will start to react to that, and they should react kind of positively. I don't think we're going to experience those sort of 20% returns we had in the markets a few years ago, those sort of things. But, you can get sort of it's very hard to say always what the markets are going to do. Yeah. And I'll put myself on the spot here, which is likely that I'll get it wrong in the short term, because trying to predict markets in the short term are tough. But let me put myself on the spot here. I'll probably think that next year you could see the offshore markets, I guess, up high single digits from the start to the end of the year. I don't know what Caroline is. I'll put her on the spot as well. I can see if Caroline has an answer there.
I'm going to say mid single digits, because
that's still positive.
Probably, right? It's good. It's good to see green. It really is. But we'll have to wait to see what happens. I really think that, first of all, I can guarantee to your clients is that when you look at your portfolios in the first half, it's going to be extremely volatile. You're going to be up a lot in one month, you can be down a lot in another. That's going to be the case in 2024, because a lot of these, inflationary related figures are, the economic stats as they come through, it's in hindsight. they're historical, so by the stage you get the figure of this, you're actually already in a worse position. And I think you're going to see the tail end of that in the first two quarters, and markets don't like that. We're trading by sentiment at this point. People are nervous. There's going to come a point where you look at the valuations of these companies and you look at their potential and you start to look through this and you realize, it's not the end of the world. It really is. That is barring any black swan events, because we definitely did. This is why I'm very reluctant to call it, because I remember sitting with clients at the end of 2021. And we actually saw that inflation was going to be an issue. What we didn't see, is the type of geopolitical uncertainty, and that's certainly risen. It's not only in Russia; it is in it's in Taiwan, China. Tensions between the US and China. Trade relations between the US and China. Those could dramatically deteriorate. So, barring these types of things. I'll go for the mid digits, but also just coming back to those black swan events. This is why we're in the companies we're in, because even if there is, some type of another invasion somewhere else, these companies will still be around. They're not overly exposed, to those regions.
Okay. And if we bring that back home now, right? So to South Africa. So look, I still think South Africa's done pretty well this year from an equity perspective. What does 2023 look like? And what impact is this Eskom story actually going to have now? It kind of seems like Eskom's been doing its own thing, but now it's come to a head where I think things seem pretty bad, and it must start to impact even more so on the economy, I would guess.
Look, I'll just say that I think, at the moment, we are hanging by a thread, and you can hang by that thread for a bit until things, really deteriorate dramatically. And I think that is, it's not just Eskom, it's collapse, it's the collapse of services generally. And there's no kind way to put it. Services are just collapsing. And, we do have, Cyril Ramaphosa's got a new mandate to sort things out, but, he's had a mandate a few times in the past. He hasn't delivered, all that much, so I'm relatively negative. Well, I am negative about the economy, but what I am still positive about is, the strength of the companies we've got on our exchange. And I love to use it as an example, ShopRite. If I think we all, Mathew, and the team, we don't only look at South African equities and offshore equities, we look at equities globally. And if you come to me now and say, do I buy local ShopRite or do I buy offshore Walmart? I'm going to go, I'd rather buy ShopRite. So that gives me a bit of hope. Our economy doesn't give me much hope, but the strength of our companies, gives me a lot of hope.
And what companies do we think are going to perform into 2023 in South Africa?
Yeah, so I mean, ShopRite is probably one that will, you'd always think would perform nicely. They continue to perform nicely. I can't see really what competitors they kind of have in their their space. They seem to eat their competitors' lunch the whole time. So that's one that everything they touch seems to turn to gold. If it's 60-60, they excellent. So that's one company that's probably going to perform well. Something else that always does nicely, and they're very well managed in South Africa, is the banks. And I think we've hopped on about that for a long time. The South African banking shares are excellent. So those will also perform quite nicely. The resource companies, if we continue to see higher resource prices, they'll do nicely on the back of that, despite all their issues they may have with Transnet and getting, their product to ports and those sort of things. I think they'll continue to do okay going forward as the resource kind of businesses as well. And then, so we have those kind of businesses that will do nicely. Pure South African kind of businesses, those, but the JSE is international as well. So, you do have other shares on there that have the international kind of flavors on them, in the likes of a Richemont, process and those sort of businesses as well. So as Caroline said, the South African economic environment might not be ideal, but the corporate environment, the business we have, they've worked around load shedding for a long time and poor infrastructure and all of that. So they've figured out ways how to get around this, so we almost, how much more impact does it have on these businesses? Yes, it does have impact on it, but we have been living with this, for 10, 15 years kind of things, and these businesses have performed very nicely over that time, and I think they'll continue to do okay because they're just good, well-run businesses that we are fortunate enough to have listed on our exchange and that we can go ahead and purchase. There are some, South African, some signs, some positive news in South Africa. If you look at some of those retailers, the retailers and the real estate businesses. So if you look at real estate businesses now, yes, office space in South Africa is a disaster because people are working from home and there's a lot of vacancy, but we're starting to see early signs that retail space is picking up. And I mean, if you go to shopping centers and those sort of things, now they're busy. So there is sort of, there's a bit of there's a economic growth in that sort of side of things that's starting to recover from COVID times. So you are starting to see this coming through. Unfortunately, load shedding and those sort of things doesn't help. And if we didn't have that, our economic growth would be much higher.
Just on the property, quick, I've read quite a couple of reports about new shopping centers being built, like bigger than the biggest one that was built the last time, right? Like, it seems, I don't know, it seems crazy that we're still growing more shopping centers, right?
Look, I think, first of all, I think the largest one that's recently been completed, just before COVID was 4 years more, probably the timing was not great, so we can look at that. And certainly if you walk around that type of shopping mall, it's the foot traffic is not great. And there are a lot of empty shops, but what do well are, these regional malls. Especially where you place them, where there's a high density of people walking through, like next to your taxi ranks and things like that. And that is what, people are always going to use because, you usually see a Capitec there, you usually see a Boxer store and those types of things. So, they have a built-in client base. From the rest of the property sector, we tend to focus on malls and offices, but there are other things that are growing, storage space, as people, it is a growing business, these little storage companies are popping up everywhere. Also, a certain type of industrial space, because now if you see delivery drivers everywhere, you need a logistics park, where they move from. So this is it's a great opportunity. I don't know if office space is going to recover imminently. But, again, if you look at the shopping mall space, you've got to look at, where the company actually sits. And also just remember that you say that they're growing, but it's not necessarily, there has been capital investment by the big property company into some of these shopping malls, but it's by and large, it has been to, bulletproof them against all of this infrastructure, issues that we have, to actually have better water supply, to put in, uninterrupted power, things like that. So, capital, but not not where you want to spend it, but they really, it's like you said, South Africa, we're very resilient. We haven't fallen apart like the globe. We've said, okay, the power is going off, so we will do this, and this. We're a tough bunch.
The resilience of South Africans is amazing, right? It's almost to our detriment. I've often said it because the more resilient we become, the more the government takes advantage. But that is what it is. Look, guys, I think let's wrap it there. I just want to say thank you to both of you. I know it's been tough this year, but I think the work that you and the team have done over the years, I look at it and say, how many clients are phoning, panicking? And I don't even think I had one this year, to be honest. Like in panic, like, what's going on? We need to sell. I'm down 30%. That's not happening anymore. And I think that's because people have confidence in the process that's going on in the back end. So I just want to say thank you for the work that you do. Thanks for having these chats with us. They're super valuable. I really appreciate it. And have a great holidays. And to everyone that's listening, have a great holidays, stay safe, and we will chat again in the new year.
Thank you. Have a
Thanks,
peaceful
Marc.
2023.
Yeah, let's hope. Thanks, guys.
Thanks,
Thanks,
everyone.
cheers.
Bye.
Bye.
Bye.